Welcome back to the channel, everyone. Today I have some irrefutable proof that Citadel is creating synthetic shares. Today I'm going to show you the statements of a fund that isn't creating synthetics and then compare those to Citadel's. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, I made a video a few days ago that explained my background in the accounting industry. Before I started making videos here on YouTube, I actually worked as an accountant for many years. Therefore, I'm fairly good at digesting financial statements just like these. So today I want to compare the financial statements of Citadel Securities, a fund that I believe is creating synthetic shares, and I want to compare those to the financials of Susquehanna Financial, a fund that I believe, from this information at least, is not creating any synthetics. Now I don't know if these are the financials for the full Susquehanna fund or just one individual department. But from this information, this department at least does not appear to be creating any synthetics. Maybe there's other departments within Susquehanna that do create the synthetics, but these financial statements alone do not suggest any synthetics because they look vastly different to the Citadel financials. So let's start by refreshing our mind and looking at the financial statements of Citadel Securities. The first big number that jumps out is these securities owned at fair value for around $73 billion. The next big giant number that jumps out is these securities sold, not yet repurchased at fair value, or shares that have been shorted of $65 billion. Now there's also another $4.5 billion of securities sold under agreements to later repurchase, and therefore they've got a total short position in this entity of Citadel of around $70 billion. Now the thing that really jumps out here to me is this line here for securities borrowed. They've only located and borrowed $1.8 billion worth of shares, but their total short position is around $70 billion. $70 billion less the $2 billion worth of shares that have been located and borrowed leaves like $68 billion worth of shares that have been shorted without first locating those shares. AKA that's $68 billion worth of failed to deliver and synthetic shares that have been created, and those failed to delivers have never been satisfied or never appropriately been closed out. Maybe the official FTD has been closed out and reset using the options chain or using some other brokers. Or maybe this is $68 billion worth of naked calls that have been sold or naked puts that have been purchased. But regardless of whichever way you look at it, that's still $70 billion worth of short positions that Citadel holds, and they've only located around $2 billion worth of those securities, and they've only borrowed $2 billion of them. Now, if we compare and contrast this to the financial statements of Susquehanna, we can see something massively different. Now, the first big number that jumps out in the Susquehanna financial statements is this $1 billion receivable from clearing brokers. This is $1 billion worth of assets held on behalf of Susquehanna by other brokers, like prime brokers, for example. Obviously, Susquehanna is not a market maker, and therefore, maybe they hold a number of those assets at different market makers or different prime brokers, for example. But Susquehanna also hold $288 million here in their personal names or personal accounts as well, so they've got around $1.2 billion worth of long positions. Now I know that Susquehanna is a smaller fund than Citadel, but I didn't think it was quite this small. This is what leads me to believe this is only one individual department of Susquehanna Group. Again, if we scroll down to the Susquehanna financial statements, we can see that they've got securities sold, not yet purchased, and securities sold under agreements of around $800 million. Now, the next big number that jumps out for me is the $1.2 billion worth of securities that Susquehanna has actually borrowed. They've actually located and borrowed $1.2 billion worth of shares, which is fairly equivalent to their total long positions. That means that actually Susquehanna have borrowed and located $1.2 billion worth of shares, but only shorted 800 million of those. Therefore, this department of Susquehanna has located every single share they are currently shorting, and they've even located and borrowed additional shares that they aren't yet shorting. When we compare that to Citadel, Citadel have shorted around $70 billion worth of stocks, but only located around $2 billion worth of those. If Citadel had $65 billion or $70 billion worth of shorts, you'd expect that every single penny of those short positions should be located and should be borrowed. Therefore, they should have $70 billion worth of shares that are borrowed, but actually, Citadel only has $2 billion worth. So therefore, while Susquehanna has located every single share that they've shorted and then some, Citadel have massive amounts of synthetic shares right here in their financial statements. Guys, if you haven't already, be sure to sign up to Moomoo using the link in the description below and make your first deposit to get up to 5 free shares valued to $3,500 each and a free share with a guaranteed value of around $20. Moomoo has also just officially announced that Moomoo and Futu do not accept payment for order flow, and therefore you don't have to worry about your trades going through sketchy dark pools or being given to Citadel. Moomoo also has tons of technical indicators and advanced charting tools. Moomoo also publishes daily short selling information, position cost distribution, and much more. Moomoo is also entirely commission free and will help you to trade like a pro. So guys, be sure to sign up to Moomoo using the link in the description below to get up to $17,500 worth of free shares. Now again, something else here that I think stands out as well is Susquehanna also have $1.2 billion worth of securities loaned out. Therefore, when somebody wants to borrow their shares, they appropriately lend them out to the receiving customer. Susquehanna has around $1.3 billion worth of long positions, and they've loaned out around $1.2 billion worth of those shares, so they're helping people to avoid the creation of synthetic shares and helping other people to avoid fail to delivers by appropriately loaning them all the shares. However, with Citadel has $73 billion worth of long positions, but only has $900 million of shares that they've actually lent out. Therefore, Citadel does not help people avoid the creation of synthetic shares and actually facilitates the creation of additional synthetic shares by other market makers. Citadel says, nope, sorry, you can't borrow our shares, we're not loaning any out. You'll have to create them yourself to fulfill your customers' requirements. Whereas in this specific department of Susquehanna, they say, oh yeah, you want to borrow some shares? We'll happily lend those shares out to you because we do not want to create any fail to delivers or any more synthetics. Now again, I'm sure there's other departments of Susquehanna that potentially do create those synthetic shares, but this department at least that's filed these financial statements doesn't appear to be creating any synthetics. It's frustrating that from comparing and contrasting these two different financial statements, just how obvious Citadel's synthetic short position actually is. These financials are filed directly with the SEC and they're available from the SEC website, so it just goes to show actually how little the SEC really cares. But as the Department of Justice and the FBI are now a lot more involved, hopefully this is all resolved fairly soon. David Neo tweeted saying Citadel sold $65 billion worth of securities that they don't own. Technically, this is the $65 billion short position that Citadel has, but remember, they've only located $2 billion worth of these shorts. So technically this is only 63 billion or 68 billion if you include those shares where there's an agreement worth of synthetic shares. And David says, in other words, they are hoping that these companies will not bounce back like Sears, Toys R Us or Blockbuster, so they never have to pay that back to those retail investors. Obviously, Citadel's aim is to drive the price of AMC and GameStop down so low that they never have to cover those short positions. If they can bankrupt AMC and GameStop and get their shares and their stock relegated to the OTC market, the stock will be priced so low and will have no chance of ever recovering, and therefore Citadel won't ever have to cover their short positions. They can just take out loans from other banks on margin and use those unrealized profits as the collateral to meet those margin requirements. And he says the Wall Street strategy is simple. Buy enough shares to control the company. Then you short the company or the stock indefinitely to send the stock to the OTC market where retail participation is almost none and you don't have many to fight with. And number 3, take all cash from shorting tax-free because the position is still open. Those shorts obviously never close their short positions, they just borrow money from other banks using that unrealized profit as collateral. Therefore, because they've never closed those positions, they never have to pay tax. But David also says the difference is they placed the wrong bet against the wrong crowd. We are going to make them pay. The SEC has been fully supporting the Ponzi scheme all of these years. They've passed laws and made some noise to make investors believe they're fixing something, but the market is completely broken. And that's why I think we need some criminal bodies like the Department of Justice or the FBI that don't just regulate the stock exchange and they aren't funded by these financial institutions. The SEC is largely controlled by Congress, which is lobbied by these financial institutions, but the Department of Justice and the FBI is largely entirely separate as they're criminal organisations. Now, I also wanted to touch on the GameStop, Loopring and Immutable X NFT marketplace, as I haven't touched on this for a little while here on the channel. Sean Fitzy tweeted saying there's a new job posting on the GameStop website that says, as we ready our NFT marketplace for launch, we're adding a technical product manager to lead the integration of the GameStop NFT platform with bleeding edge back-end technology partners. In GameStop's latest 8K filing, they recently announced that the GameStop NFT marketplace will be partnering with both Loopring and Immutable X, and therefore we have guaranteed confirmation that GameStop are indeed working with Loopring. The GameStop NFT marketplace was supposed to be released in Q4 of 2021, but has obviously run into some delays. However, I do think GameStop will shortly be releasing their NFT marketplace as they're readying the marketplace for launch. They've already opened and closed their NFT marketplace to new NFT creators that are going to be listed on the platform. Therefore, they've already got the NFTs. They now just need to launch the marketplace. When this NFT marketplace is launched, maybe this month or over the next month or two, I do think the Loopring crypto will move back to its previous highs and far past them, especially if the wider crypto market trends upwards as well. So guys, be sure to let me know down in the comments below what you think about the proof of Citadel creating synthetic shares. Do you think Citadel are creating them based off their financial statements compared to the Susquehanna statements? And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.